So the small cap, large cap ratio hit another new low. What does it mean going forward? Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Thanks very much for tuning in to the YouTube channel here. Of course, if you like the video, give it a thumbs up below. And if you would like to be alerted to future videos, you can always click the subscribe button. Today, I want to talk about the ratio chart using the S&P Small-Cap 600 relative to the S&P Large-Cap 500. It hit a new low. But as we have seen in the past, a new low in that ratio doesn't necessarily mean a bearish outcome for the stock market. The S&P 500 can continue on even when small caps underperform. Let's hit the charts. So let's start off with just a basic chart. This is a line chart for SPY, MDY, and IJR, large caps, mid caps, and small caps. And you can see here is the S&P 500 SPDR, and it held its 200-day there in August and in October. And you can see mid caps dipped just below the 200-day, and small caps did as well. So, from the chart basis, basically, you can see that small caps were clearly lagging in the summer there. And you can also see the peak there in May and the lower high, as well as a lower high in mid caps. But then things started to change as we got into October, because what happened was you had the first higher high in the small cap index here. So you got above that July high in October. And if you look at mid caps, they did not, and neither did large caps. So you started to see a little bit of relative chart strength, if you will. Then we got the higher low here, and then a breakout there and 52-week highs. So currently, IGR is above its 200-day moving average and still performing just fine. It's just not performing as well as the S&P 500 SPDR, which has a steadier upward trajectory in November, December, January, and now February with a new high. So you can see a new high in SPY has yet to be confirmed by MDY and IJR. But SPY is kind of its own beast. As we'll see a little bit later on, the top 5 components account for like 18% of the ETF and the S&P 500. So now we're going to move over to indexes, and we've got the S&P 500, and we're going to also just focus on small caps relative to large caps. And you can see here since January 2019, small cap index is up 20%, and that is not shabby, okay? That's clearly not a weak index over the past year or so. But the S&P 500 is even stronger. It's up 35%. So I think the main reason that small caps are lagging is not because they're weak. It's because the S&P 500 is so strong, and that clearly makes small caps relatively weak. But it's not like they're weak on an absolute basis, and I think that's a big difference. Now, sure, we got a little absolute weakness from mid-January here to early to mid-February, but that's a little short-term issue right now. But overall, you can see small caps have been lagging large caps since February there, as that ratio moves down, the small cap to the large cap ratio, and it hit a new 52-week low. But as you can see, that ratio has been falling, and the S&P 500 just continues to move higher. So we can't extrapolate that relative weakness in small caps is going to lead to a bear market, because it has not affected the S&P 500. And as far as I'm concerned, the S&P 500 is the 800-pound gorilla in the stock market. And you can't have a bear market until this 800-pound gorilla turns. And it shows no signs of turning. Maybe correcting, but not a long-term trend change. So what is holding up or pushing the S&P 500 higher? Well, I think most of us know the answer to that question. It could be what we call the big 4+1. And I would put the big 4 as being Microsoft, which accounts for 5.17%. Apple is 4.83%. And then you got Google coming in twice. So that makes it 3.24%. Then you got Amazon at 3.19%, and the plus one would be Facebook at 1.84%. And together, these five account for just over 18% of the S&P 500. That is a huge amount for just five stocks, and they're the ones that are responsible for a large portion of the outperformance in the S&P 500 versus the S&P Small-Cap 600. And here's what it looks like on a chart showing performance for the big five that I just showed you there and the S&P Small-Cap 600. There's the S&P Small-Cap 600 up 21% since January 2019. A very healthy gain. Anybody would be happy with 20% over a 13+ month period. But then you look at Apple. Apple's doubled. It's up 104%. Mr. Softy, Microsoft, is up almost 84%. And you have Facebook up 55.5%. It took a hit recently. And then you can see coming in at the bottom, we've got Amazon up 45.5% and Google up 44%. But clearly, they're all up more than double the performance of the S&P Small-Cap 600. And you can see Microsoft and Apple just taking it to another level. So I think what we can gather from this analysis is that small caps are lagging not because they're weak. Small caps are lagging because large caps are really, really strong. You got these five big stocks leading the large cap S&P 500 higher as well as the NASDAQ 100. And as long as they continue to seriously outperform, that ratio of small caps to large caps is going to continue to decline. But that is not necessarily bearish for the S&P 500. So again, thanks very much for tuning in to this video. If you like it, give it the thumbs up, please. And if you'd like to subscribe, you can click on the link below. Thanks for tuning in and have a great day.